Our fund actually delivered returns in excess of 21%.
You are up 21% while the index is down 3%.
Scored 24.9% alpha for the financial year.
Wow. What advice would you give me for somebody investing today?
These kind of volatilities actually present a suppressed price, suppressed valuations, which actually give you a better opportunity to make much more. As we go more and more AI, we are actually going more and more physical. Why? Why do I say that? For having more and more of AI, you need far more physical data centers.
I heard about this data center thesis many times, but how do I invest in data centers in India?
Amongst the funds that I manage, the oldest fund has delivered an alpha of about 3.8%. Let me put it this way. Somebody who would have invested 1 crore, that 1 crore would have become 34 crore in the index because of that 16% compounding. But the same 1 crore would have become 74 crore in the fund. 3.8% alpha can make that 34 into 74, and these are delivered numbers.
It can double.
Yeah.
So right now there are 6,000 stocks. How to know which stocks to pick?
The most important thing that one can do is
All right, Alok, welcome to the show.
Thank you. Pleasure being here.
Alok, I was just going through your background and you work in a company called Alchemy Capital Management.
Yeah.
And you're the head fund manager over there. As of today, you manage about 2,500 to 3,000 crores, if I'm not wrong, right?
Yeah.
So before we get into that, if I had to ask you, if I am investing today, right now, and I know you typically advise HNI clients and ultra HNI clients, but if I had to invest today, let's say 10 lakhs, 25 lakhs, what advice would you give me for somebody investing today?
So, having spent over 2 decades in the market and we have seen several events taking place, right? We understand there's a geopolitical tension right now also. And there was a war that broke out 3-4 years back. Prior to that, there was COVID. Prior to that, we had multiple issues in terms of earnings growth not being there. We had the global financial crisis as well. As we go back into the dates, there are multiple such crises that happens. All I found was the people who became rich were not the ones who timed it right. They were the ones who stayed long enough. So if your compounding machine is such wherein it's coming from the overall economic growth and the earnings growth of the corporates, if the overall economic machine of that compounding is working very well, these kind of volatilities, these kind of events actually present a suppressed price, suppressed valuations, which actually give you a better opportunity to earn, to make much more. But as I always say, good prices and good news, they never come together.
Good price and good news.
Yeah, they never come together. When the news is bad, you get good prices. The moment the news get good, the prices aren't that attractive. And then we start thinking, I wish I had invested at that time.
But people invest during good news time.
Yeah, so we want good news time and then wait for that good prices to be there. They don't come together. So it's better to be knowing that where to invest, and when the news is bad, instead of getting swayed down by the overall negative headlines, use that as an opportunity to build that portfolio.
So Alok, you've been managing money for almost 20 years now.
Yeah.
Right, more than 20 years.
Yeah.
And as of today, as we sit, you're managing 3,000 crores.
Yeah.
So can you tell me a little bit about your performance of managing this fund? Like what kind of performance have you delivered in the last 3 years and 5 years period?
So over the last year, 3 year and 5 years, so my objective generally is if we can deliver an alpha of about 3 to 5% over and above the benchmark.
Okay.
So the fund that I manage, amongst the funds that I manage, the oldest fund is Alchemy High Growth. And that's about to complete 24 years in existence. And over this period, it has delivered an alpha of about 3.8%. So
over the 24 years?
Over a 24-year period, a 19.8% return versus a 16% for the benchmark.
Okay.
But this percentage numbers, they mask a lot of compounding benefits. Let me put it this way. Somebody who would have invested 1 crore at the start of that fund in May 2002, that 1 crore would have become 34 crore in the index because of that 16% compounding. But the same 1 crore would have become 74 crore in the fund.
Wow.
So 3.8% alpha can create that additional can make that 34 into 74, and these are delivered numbers.
It can double.
Yeah.
An additional 3-4% alpha can double your final amount.
Absolutely. So that's the benefit, that's a magic of compounding.
Interesting. And what about the last 5 years though? That is what's more interesting for people to know, because last 5 years is when most people invested.
Yeah. So in the last 5 years also, our alpha has been quite good. So it has been around 3.5% alpha over and above the benchmark. So good thing is being able to deliver consistent alpha over the last various periods, whether it is 1, 3 or 5 or more. So that has been the hallmark of the fund and the strategies.
And let's talk about specifically last year.
Yeah.
Like 12 months from now, from back 12 months back, how has the performance been?
I think last 1 year also have been, God has been pretty kind, I must say. So if I look at 31st March data also, so while the indices were down little over 3% for the financial year, our fund actually delivered returns in excess of 21%.
Positive.
Yeah.
You are up 21% while the index is down 3%.
Yeah, so it's a record 24.9% alpha for the financial year.
Wow. Congratulations.
So that is so much.
So now let's talk about how to do this, because most people cannot afford your services. I think minimum check size will be 50 lakhs to work with you.
Yeah.
So most of the people can't afford your services. So please break the alchemy here for us and unravel the secrets of how to do this.
So idea here is you have to maybe combine a lot of stuff together. If I try to put it in simpler terms.
Let's start from the basics.
Yeah.
I will tell you what the average investor today knows. They know about mutual funds. They know all the types of mutual funds. They know what is large cap, mid cap, small cap. They know all of these things.
Yeah.
From here, how do they generate alpha? That is the objective of today's session. And also, how do you protect drawdown? Because market gave -3%, you are up, how much you said?
21.8.
21.8%.
Yeah.
So you are doing something crazy. So let us take it step by step and start from that ground level of knowledge which most people have, which is about mutual funds.
So I think the key to success here lies in being very, very disciplined. And it's quite heartening to see that investors are actually being very consistent with the SIPs. That's a key. That's most important. I would rather say that whenever there is correction, and when the last few months or a couple of years period, like the way it has been in the last 2 years, when they don't look too encouraging, I think that should be used as an opportunity to build up further positions in equity, because the runway of growth in India is pretty long and pretty good. So that's the first thing I would say. The second step then comes into selection of funds, and that's a different kind of criteria. So mine is more into selection of stocks and sectors. So go into those funds and sector stocks that are having a much higher growth probability and structural growth ahead of it. So I would not really go for things which are just looking good for the short term. I'm not interested in too much of very short term trades. But don't try not to miss the forest for the trees. So something that is structured in nature, go for the biggest themes that are going to do very well over the next 5-10 years. So once you have a long runway of growth ahead of you, all you need to do is just be consistently disciplined to put the money in those funds.
So what is the step one? Step one is basically invest in themes which are structurally going to do well, not just for the short term, but for the long term. So essentially, you're talking about top-down approach and select the right sectors first.
So let me put it this way, that see, when you're investing in a mutual fund or a PMS or any such product, it's the fund manager who is doing that for you. You go into stock selection only when one is going for direct equity investing. So if you are into the mutual fund investing, the most important thing that one can do is try to have higher amount of your income or higher amount of your savings being parked into those funds on a regular basis. So it is because the compounding will do the rest. Our job as an investor then is to start committing that amount of money every month so that also keeps growing.
So tell me how you do it. Let's say I give you a 1 crore check.
Mm-hmm.
How do you decide where to put that money? Can you break that process for me?
Yeah. So when it comes to me, when I have to allocate, so what I'll try to do is I'll try to look at those sectors and companies that are likely to compound at a higher pace. I just said that, for example, if the country grows at around 10% nominal GDP, and if the corporate earnings are growing at around 12-13, and if I want to generate a higher return than that, my companies need to grow at a higher pace than that. So at the core of it, I am a growth investor. So for me, the first and foremost important thing is that the company or the sector where I put the money should be able to grow that much. So if my understanding of the top down and the bottom up of the sector and the company is that the company is likely to grow at a much higher number than say 14-15% plus for a longer duration of amount of time, then that's the kind of sectors that will be there for me to invest. But then you start looking at various other aspects. So whether among others aspects would be what's the quality of earnings. So, in this country, on 100 rupee capital to earn 6 rupees, you can invest in a simple GSEC as well. But companies that are generating 15-20% plus on their invested capital, they must be doing something very good. And especially on that, if they're able to grow it 15-20% plus, there's something good that they're able to do. They must be facing competition also, but yet if they're able to do, that is a demonstration of the kind of strength in their own businesses. So that gives you further confidence that not just that they have grown at a higher pace, they are capable of growing at a higher pace in the going forward future as well. Because until unless my companies grow at a higher pace, how will the fund grow at a higher pace? So that's the objective.
So right now there are 6,000 stocks. How to know which stocks to pick? Like when you pick, like let's talk about your specific fund.
Sure.
So right now, what is the asset allocation in your fund? How do you invest? 100% equity?
Yeah, it's 100% equity, and as a process, I don't really take cash calls.
Okay.
So at any given point of time, I'm typically more than 95-96% invested.
So then how are you able to protect your drawdowns? Because when the market has given -2%, you're up 18, how much you said?
About 21 plus.
About 21%.
21.8, yeah.
And you're telling me you didn't even take a cash call.
No, never.
How is this possible?
So this is possible because if you are in the right sectors and stocks, you might actually do pretty well out there. So for me also, being invested in some of those sectors like the exchanges and the metals, which did very well, which are underrepresented in the index, and the index heavyweights did not do too well. So that actually worked in my favor.
So tell me, what is your industry allocation within your fund right now? Tell me the percentages.
So if I give the breakup, for me, metals and metals related sectors are close to 40% of the fund, which is significant overweight compared to the index. And I have nearly 40% into the financials as well. But unlike the index, which is focusing more on the large private banks, my focus is more on the capital marketplace, the PSU banks, and some of the smaller private banks. So this is where the major part is. Also bullish on some of the industrial names like power and defense. So these three actually hog major part of the portfolio.
40% in metals, 40% in financial companies which are on the exchange side and not the typical private banks, but the exchanges and the
PSU banks,
PSU
smaller
banks.
private banks.
And the last 20% is in energy.
Energy, power and defense.
Energy, power and defense. So no automobiles, no IT, no pharmaceuticals, no, what do you say, the most popular industries that people typically invest in. You don't have any of those.
Yeah, so no IT, no auto currently. Auto was there at some time back, and no FMCG currently. There's some exposure to the pharma segment as well, apart from these top sectors.
So how did you decide that? How did you decide to put 40% in metals?
So it's a slow and steady process of building further positions as we see the clarity in earnings as well. So is this, for example, if I just look at metals, just pure earnings itself, while we have seen single-digit earnings growth on FT for the last 8-10 quarters, metals and mining as a sector, last 8 to 9 quarters, they have been delivering more than 15-20% earnings growth already. Then when you break that up as to...
Like, can you name some companies here which have been doing this?
Yes, the companies like Vedanta, Hindalco, Hindustan Zinc, Hindustan Copper.
And why have they been doing so well compared to the benchmark?
And then comes the... Ultimately, when you look at metals and mining, they are all commodity manufacturers, right? So a lot of them depend upon, their profits also depend upon the kind of demand as well as the price of the commodity. And the commodity pricing, because investing in metals and mining is also call on the overall metal, how will that do? So my call had been that the metal space, especially the non-ferrous part and the precious metals part, are actually quite attractively positioned. So that's where that's also part of the overall main change that we are witnessing globally, that those metals that were kind of neglected, the precious metals and the non-ferrous ones, are becoming so and so important. The three things that I look for when investing in a commodity: number one, that commodity has to be in deficit already. Secondly, if it is in deficit, that deficit needs to continue. And for that to continue, the demand needs to be relatively inelastic. What do you mean by that? That if the commodity prices go up a little, if the demand comes down, the deficit will not remain. So that demand needs to be relatively inelastic so that even if the prices go up, the demand shouldn't come down. And the third part is the supply should be very difficult to increase. Because if your demand is relatively inelastic and growing, supply cannot match up. That deficit will keep on growing. And if that deficit keeps on growing, the metal prices are likely to remain more and more buoyant. Plus, they have been neglected for last several years. So that means there's a lot of catch-up that can happen, but if that deficit persists. So I do track these to ensure that some of these metals are in a very opportune time for a longish cycle to play through. And then when you are so positive on some of those commodities, the mining companies make much more money. Thankfully, in India, some of these miners are amongst the lowest cost producers in the world also. So they will always be the last man standing for such kind of metals too. So that's a broader call. That's an important call for me as well, and for the fund too. And that has been working well, but I do think that we're in the initial phases of that cycle that's unraveling. But I do think there's a longish way ahead of us.
So instead of investing directly in the metals, why did you invest in the mining companies? Like, is that going to give better returns compared to investing directly in the metals?
So, yeah, historically also that has been the case. But let me put in a very simple way, that ultimately when a metal price, say, multiplies by 2 times or 3 times, look at a company's revenue will multiply by that much, but there are always costs associated to it. When you look at the impact on the net profit, then net profit may actually multiply by much more than the overall selling price. So even if the valuations were not to change, typically when your growth rates accelerate, the valuations also accelerate. Even if valuations were to not accelerate, the impact on the profits of a mining company is far more amplified than the impact of the overall commodity price. So miners tend to do much better in a longish bullish cycle in a commodity.
So earnings growth will be faster than the price growth of the metals.
Correct.
You were convinced that this is going to happen, and you started building positions slowly, and you increased it over time. Now tell me, like, along this theme, why did you not select healthcare? Because I can also argue that there are a lot of tailwinds for healthcare industry as well. History has shown that when a country goes from developing to developed, and as the GDP per capita increases, the wallet share on healthcare expenditure increases, and also the medical inflation is quite high. So, invariably a larger amount of my money is going to get spent on, healthcare, pharmaceuticals, diagnostics, etc. You didn't, go after that theme?
Yeah, I have been bullish on them. So yes, at the current juncture, there may be lower allocation in the portfolio, but I'm quite bullish on the overall healthcare theme. Within that theme, as you rightly mentioned, for me, the theme that stands out for longer term structural growth is actually the hospital sector. So, in India, the overall hospital coverage for the private side especially is quite limited. And as we were mentioning, if India is growing, overall per capita income is likely to double in less than 10 years. There will be far more demand for the private hospital rooms, and that is undersupplied currently. So that's where the volley opportunity is there. But some of these sectors, some of these stocks have actually done pretty well in the last 5-6 years. So I have to look at the risk reward ratios as well, whether I need to be
price discovery has already happened over there.
So I'm very bullish on the sector. So not even saying painting it red at all. I'm very bullish on the sector, but possibly at current times for the medium term, I was finding better risk reward opportunities elsewhere, because ultimately I keep a little more concentrated fund of about 20-25 stocks only.
That's it?
Yeah.
Wow. And then you mentioned defense and
defense, power, and energy. Yeah.
So can we talk about these three sectors?
Yeah. So defense, I think, is a revelation that has happened in the last few years only. Typically in India, although it was a major part of the budget, but majority of that money is to go into the administrative costs and imports. So as an industry, we never really saw too much of it. But the geopolitical tensions in the last several years ensure that India took a strategic call and that we need to be a little more self-dependent. So that's where a major part of that budget started coming into the defense side. So that's an area that the focus of the government has been there to increase the defense allocation. So you're getting the money on the defense side. Now you look at the global side. Globally, roughly 2.5% of GDP is spent on defense, if I combine all the countries.
Okay.
But look at the geopolitical tensions of late. We are seeing the US-Iran war that's still underway. We saw a few years back, Russia attacked Ukraine and the war doesn't seem to end at all. And small skirmishes keep happening. In the meanwhile, the US announced as if they are not going to be providing the defense cover for the NATO countries. All of them need to fetch for themselves. So each one of them would be spending a higher proportion of their GDP on defense. If 2.5% of GDP spending on defense looks high, if I go back in history, during the Cold War times, roughly 6% of GDP used to be spent on defense.
Wow.
So globally, the GDP pie will rise. The exposure or the expenditure on the defense will rise at a faster pace because 2.5% is likely to move higher.
Yeah.
And it's coming at a time when India is actually kind of ensuring there's more investment done in the local industries, which not only caters to our domestic requirements, but in certain areas we're able to export as well. So our export capability is rising at a time when globally there will be far more spending. So this sector is actually poised for a longish term growth for nearly a decade. There will be ups and downs. There will be volatility on the way, but this presents a great opportunity for the next decade.
Why is defense still a minority in your?
Again, that's a risk-reward call. So sometimes you like certain sectors. This is the second one that you speaking about, say hospitals and defense. They were there at a higher allocation some time back. They have been reduced as an allocation on a risk-reward basis. They may come back into the portfolios when the risk-reward looks far more attractive.
You kept saying this risk-reward about 3-4 times. So I think it's a good idea to deep dive on that. Like, how do you assess risk-reward ratio? Like, for example, today, let's say 40% of your fund's money is in metals.
Yeah.
What exactly are you tracking to see if the risk-reward ratio is holding up? And if it breaches a certain threshold, you're like, okay, now it's time to pull money out and pull somewhere else. Can you break that down for us?
Yeah, that's an interesting one, Sharan. Let me put this way. If I'm comparing, say, two sectors, say metals versus defense, typically I'll not do that, but suppose if I do that, so which sector is likely to have a higher growth rate with lesser chances of disappointments? Then comes the valuation side and the over and under ownership side. So when you see that the sector has been delivering, likely to deliver with very low chances of the disappointments coming in, and majority of the world is actually underweight or not really owning it too much, it's not an over-owned sector, the chances of that doing well actually goes up.
Okay.
So that's the risk reward I'm talking about. Secondly, if the growth rate is there, but you tend to overpay for that, then that's an area of concern.
So wait, the first thing is mostly about the tailwinds, that the tailwinds are still there. There is room for growth.
Correct.
But
There are headwinds as well, that which one has lesser headwinds.
Which one has lesser headwinds? So that is a call that, okay, I need to be invested here.
Yes.
But now how much percent to be invested here is a metric on, it is determined by the valuation of that sector.
Correct.
So can you
valuation
quantify
as
that?
well as the growth prospects.
So can you quantify that for me?
Difficult to put an exact number, but let me put this way, that suppose a company has a lot of order book, but is not being able to execute at the pace at which the orders are coming. So suppose the execution is slower than the order book accretion. That means the revenue growth is likely to be less than the order book growth. So if their execution goes up, then that's good. But if the prices are building in, already pricing in that a high execution, high growth will be there, So that's the call that one needs to do.
What do you think of the IT sector right now? Because it has corrected a lot. Do you think it's a value buy right now, or is it in a structural breakdown because of Claude and ChatGPT?
So I, for one, have been quite vocally not so positive on the IT sector in India, especially in the last couple of years. And
You've been saying it for the last couple of years.
yeah, I've been having zero position in the sector.
Okay.
So it may have broken down off late, but yeah, I've not been positive on the sector at all. Primarily, as I said, I'm a growth investor firstly. Let's put it this way. If I just remove that Claude or the AI angle separate also, the IT sector as a whole in the last 5 to 10 years, if I look at their earnings growth numbers, they are barely 10%. Now let's put in a simple terms. Last 5-10 years, there was no AI.
Yeah.
Then they reported 5-10%, under 10%, 19% kind of growth. Next 10 years, there will be more AI. Now with the competition and a lot of impact coming from AI, is this 9-10% growth number likely to go up or go down?
Go down.
If it is likely to go down, if that's my view, if it is likely to go down below 9-10%, if the companies and sector I invest in is reporting single-digit growth, how will I report high double-digit returns? It doesn't fit into my method.
I see a lot of news about them now announcing investing in AI at this, but what you're trying to say is it will take a lot of time for the transition to happen.
It's far too late.
Yeah.
So thankfully they had a lot of cash generation happening over the years.
There are billions of
They
dollars
could have
of
been
cash.
used it for multiple other purposes like acquisition of smaller companies, possibly, I don't know.
They didn't do it.
Building their own capabilities or acquiring capabilities.
Yeah.
But they were giving away dividends and buybacks. So not right or wrong, I'm no one to judge. See, for me, all I need to see is the companies I invest in should be growing at a faster pace. If they are unlikely to grow at a faster pace, my buck already stops there.
Yeah.
So I do not see a major reason for their growth numbers to shoot up. So that's where my discomfort on the sector is. They are not the beneficiaries of AI. They are the ones who are likely to get disrupted by AI.
Any other sectors that you're bullish on?
As I said, power and energy as well. So the great change that's happening globally also is as we go more and more digital, as we go more and more AI, we are actually going more and more physical. That sounds counterintuitive, but I'll repeat that. As the world goes more and more artificial, digital, it is actually being forced to go more and more physical. Why? Why do I say that? For having more and more of AI, for having more and more of digital, you need far more physical data centers, far more power infrastructure, far more energy sources.
No, I heard about this data center thesis many times, but how do I invest in data centers in India?
So in the listed space, there will be limited opportunities. So what is happening? One is things for clear. Ultimately, data centers requirement also came because of the overall AI investments. So how I also go about this is I use a pick and shovels kind of a strategy. So while AI capex is happening, let me explain that pick and shovel strategy first. It will be an interesting thing, right? Because we read about it, but it's important to know what it is.
Yeah.
So if I go back, say in the 19th century, somewhere around 1840s,
The gold rush.
the gold rush was there. So the gold was found in California and lakhs of people moved there. Everybody wanted to dig, find out gold. Those who could find gold would have become very rich.
Yeah.
The first billionaire out of that gold rush was not somebody who dug to find out gold. That person, all he did was, once he knew that this gold was found, he tried to corner all the picks and shovels in the market. When everybody got to know that there's gold here and there's a gold rush, everybody wanted to dig. To dig, they needed picks and shovels. Whether they find gold or not is a separate matter. But certainly picks and shovels was being sold at a high premium. You use the same context now. Multiple companies having their own AI. Who will succeed, God knows. I am not able to judge. But one thing is for sure, each one of them have to do that capex. Each one of them have to build that data center. Each one of them have to invest in those semiconductors and chips and so on. In all those building blocks, those which are in short supply are the picks and shovels of this age. The copper, the silver, the transformers, the HVDC lines. So whichever those areas are there, which are the abundance can be questioned, but that's required in that building blocks are your today's picks and shovels.
Which is why the Taiwan and the Chinese companies are.
Yeah. So a lot of these companies, globally you're seeing this rush. So be it on the memory storage side. So multiple of them are there, but in India, a lot of them are available in some parts. So be it some semiconductors, some power, but predominantly, as we mentioned, that's also one of the reasons for me to be so bullish on the non-ferrous side of the metals as well.
So will you go more and more bullish on this as the year progresses?
So my allocation is pretty high already.
No,
So
it's not. No, that's less than 10%, right? Because 40.
on power, yes, power is 10. But yeah, on the metal side, which is also, they classify metal separately, power separately.
Right.
But for me, a lot of them is also a part of this AI
Metal.
picks and shovels strategy as well.
Got it. It's
But
already
yes,
part.
power is a sector. I will not see the whole value chain, but certain parts of the value chain quite positive. And with time, there will be higher exposure as well. I had higher exposure in the past too. But then I found a higher risk reward, better risk reward in metals. That's how the shift happened. Again, there will be higher allocations in that. So these are areas of dominance, areas of growth for the next decade. But as we were trying to say, look at the names that we mentioned: metals, the capital marketplace, power, defense, energy. They were virtually not even present in the last decade.
Yeah.
Nobody took their names. They were like shunned out. That's why there are not too many analysts of those sectors as well. So highly under-owned and highly overlooked. As they say, the best of the investing themes sometimes come when the obituary has already been written. So they are being doubted. They are being approached with skepticism, but they're delivering non-stop. That's the beauty of it.
Perfect. I think, Alok, now let's get to the rapid fire round. I'm going to ask you some quick questions and I want some quick answers. One macro indicator you're tracking right now very closely.
For me, it's the GST collection in India. That's a number that closely has a resemblance to the overall nominal GDP growth, overall economic activity. That comes monthly. So that's the fastest way to understand how the overall economy is doing.
So monthly GST collections.
Yeah, how they're growing on a year-on-year basis.
And right now, is it growing?
It's growing at single-digit number for last 10 months. But part of that is
Annualized single digit growth?
Yeah. So for example, 8-9% growth is the number in the last few months that's coming. That's not a great number, but I must also say that in September, there were the cut in the GST rates. So some part of that is getting impacted. The numbers are showing an improving trajectory. So that shows that, the overall economy is also growing at a reasonably good pace. My sense is that these numbers should start improving, but they will be the first economic indicator to reflect that the growth is coming back.
Which of these will come first from today? Nifty record highs or another sharp correction?
While I don't know the answer, but my sense is the record highs should come first. I do think the risk reward is in favor of markets moving up. But again, a lot of things can be event driven. But if I have to pick one, my sense is the record high should be first.
Large cap versus mid cap versus small cap. Where would you deploy 1 crore right now?
Tough one, but a majority of the sectors that I am positive on, they belong to the largest mid caps.
Largest mid caps. So companies from the 150 to 200 rank.
Yeah, that majority of my companies and the metals and the capital marketplace happen to be in that zone, because I'm more positive on the sectors right now rather than the capital, large cap, etc. So I'm very focused on those sectors. So those sectors lie primarily slightly on the large cap and more on the mid cap side.
One framework you swear by when it comes to equity investing.
Growth and peg ratios.
If the dollar weakens, where do the global flows shift next?
It has to shift more towards the emerging markets. And they have been doing that over the last few months, etc. But yes, India has not been able to participate in that flows. But yes, emerging markets will get more money. And I'm expecting India to start getting more on that share as well.
US markets versus Indian markets, which has a better risk-reward ratio today?
Today, definitely India.
One global market you would completely avoid right now.
It's actually the US market.
You'll avoid it completely.
Yeah, I do think that it has done pretty well already at close to 65% of world market cap with just 25% of world GDP. It has already run its course. Last time Japan did that, it was 18% of world GDP and reached 48% of world market cap. We saw 2-3 decades of no returns.
Wow.
So I do think, I may not be exactly right in the timing part, but I do think it's a too high disproportion. 65% of world market cap with 25% of GDP is too high.
But if the AI boom continues, won't they capture more profit pools from the world?
Again, as I said, majority of the money was not made by the people digging gold. It was made by the people in the picks and shovels. And those picks and shovels are not necessarily there in the US. It's there in elsewhere, other countries.
Interesting. What's one unpopular view that you have right now, which people in industry will be like, that's not true?
As I said, being so heavyweight on metals and not liking large private banks and IT.
Got it. So I think that was all the questions that I had. Is there any last piece of advice that you want to share the audience who's been watching you for almost an hour now? What is the last piece of advice? And these are retail investors who are listening to you.
I would say, guys, we are living in a golden phase, a time where India's population is young and our growth rates are world beating. In the next 10 odd years, not investing in India or not to invest or whether to invest is not a question. It's all about buckle up, learn to stomach the turbulence. That's the only way to reach the destination. So don't be bogged down by the turbulence of volatility. That is your friend. When volatility makes you fearful, try to allocate higher proportion of your savings. But believe in this idea called India. It has delivered in the past, but the future is equally bright, if not brighter. And pleasure being here. And every moment of that was really enjoyable. Thank you so much.
Thank you so much. And thank you so much, guys, for watching till the end. Please feel free to drop your guest recommendations in the comment section down below, and we'll try to get them on our next episode. On that note, I'll see you in the next one.
Before you go, guys, if this video gave you even one insight and made you feel differently about money, don't just keep it to yourself. Share it with your friends or family member who could use it too. And if it has sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make this conversation sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with one new thing every Wednesday and Saturday.